we are going to do closings as soon as I get there. So this is learning objective 3, and it's preparing closing entries. Now, after we've pulled off all of the financials and all of the data we need for that period, we now have to start looking forward to the next period. And the one thing we really need to understand is there are two types of accounts. You have what they call permanent accounts, which carry a balance from period to period, which would actually be the balance sheet accounts. That carries your accounts for your current assets and your long-term assets, liabilities, and owner's equity that are always going to be with the company. Now, those are called permanent or real accounts. The other accounts, which are on the income statement, because they are gathered and tallied from period to period, after a period ends, they have to be taken to zero, balanced out. They need to be what they call in accounting closed out, so that when you start a new period, you have a zero balance to start accumulating money or to accumulating numbers for the period that you're now in. And those are called temporary accounts. So temporary accounts don't carry forward a balance, where permanent accounts do. And the temporary accounts have to have zero balance at the beginning of the next period, which is kind of what I think I just said. So we're going to zero out all the temporary accounts. And that kind of looks like they set up a clearing account to help you do this. It's sort of like moving around 3 cups, you know, what's in here. So this is what it looks like. You're going to take your revenues, that account, you're going to debit it, and put it into an account called the income summary. You're then going to take the expenses, credit that account, and debit that amount into the income summary. That's going to give you the net loss or income, and then you are going to close the income summary, because you want it to have a zero balance also, into the owner's equity account, which would then bring it up to date, correct? And then you would transfer your drawings into there. So those are closing entries. Let's see what this slide had on it. I guess it just explained what I did. Here's a visual of that. So the income summary is a temporary account along with your revenue and expenses, and it's used for the closing process, and it is sometimes called a clearing account. It literally is just a temporary holdings account so that you can net the revenues and the expenses to get them into the owner's equity account. And there are 4 steps, I believe, if I remember right. Step 1 is to take the fees. Okay, you know they have a credit balance over here. You're going to debit them in an entry, and you're going to credit the income summary. That's step 1. Step 2, then, is to credit all the expense accounts. See these? Whoops, let's see if we can make that go back. All the expense accounts, and we're going to debit the income summary. Now, what is the result of that? If I net those two, I come up with the net income we came up with on the working worksheet. Now, my next thing to do is to take and debit the income summary. What's that going to do to that? that's going to, I'm going to credit that. Debit, yeah, I'm going to debit the income summary for the difference between the two, and that goes into the capital account. Now, one more step. Let's see what we do on this one. It's a surprise. Then we're going to look at the capital account, which is the drawing account, and we're going to credit it and debit the capital account, which is going to deduct from that. So that should give us the balance that we need for the capital account that showed up on the balance sheet. So after the closings are posted, all of the temporary accounts should have zero balances, and you want to check that. All your revenues should be zero, all your expenses should be zero, the net income summary should be zero, and the drawing account should be zero. You're going to pull all of that off again and do a post-closing trial balance, just to make sure things are in balance before you start over again. And this is what it would look like. And by golly, that's exactly what your balance sheet looked like, your classified balance sheet looked like. So those are closing entries, and that has to be done at the close of each period. So it's not as bad as it looks, as long as you remember the 4 steps. Here's step 1, step 2, step 3, and step 4. These are your actual journal entries. So now we are off to summarize everything.